Hey, what's going on, guys? My name is Richard Moglen, and in this video I'm going to show you everything you need to know as a college student to start successfully investing in the stock market. At the University of Maryland, I was given the opportunity to take a financial literacy and investing class as a part of the honors program. I came out of this class with two realizations. The first is that anyone can learn to successfully invest in the stock market. And two, that this information should not be restricted to only people who have taken this class. In fact, it should be available for everyone. College is supposed to prep us for our professional lives, and money management is something everybody needs to be familiar with. That's why it's my view that colleges should offer a class which teaches how to budget, how to do your taxes, how to be financially literate and invest in the stock market. These are money management skills that everybody should have the right to learn how to do. This is in part why I created this channel, to help teach these skills to others who maybe didn't have the same access that I did. So for this video, I'm going to show you the basics of how to invest in the stock market as a college student. And don't worry, you don't need to have any prior knowledge about the stock market and how it works. I'm going to cover everything I can in this video, and if you still have questions, make sure to leave them down below in the comment section, and I'll be happy to answer them. It's going to be a long video, but make sure to watch to the end if you can, and if not, I'll have time codes in the description which link to specific sections that I'll be talking about. So feel free to jump around to topics that interest you or that you don't know much about. And also, please take the time right now to like this video. I spent a lot of time and effort planning this and putting this together, so I would really appreciate the support. But anyway, let's jump right into our first topic, which is what exactly the stock market is and my suggestion for what to invest in. So first, the stock market is actually composed of several smaller stock exchanges, which is where people and investment companies go to buy and sell shares. In the US, the major stock exchanges are the New York Stock Exchange, the American Stock Exchange, and the NASDAQ, or National Association of Securities Dealers Automated Quotation System. You have no idea how many takes that took. So at these exchanges, people buy and sell individual stocks or shares of ETFs and mutual funds. You're probably most familiar with individual stocks, where you buy and sell a small stake of ownership in a company. Now, investing in a mutual fund is a little bit different than with individual stocks. A mutual fund is an actively managed fund controlled by an investment organization, and this organization buys and sells shares of companies using capital from you and other investors. So when you buy a share in a mutual fund, what you're actually buying is partial shares in many different companies. Likewise, an exchange traded fund, or ETF, is a little bit different than individual stocks. It also invests in many different companies, but the main difference between it and a mutual fund is that it's not actively managed. Because ETFs are not actively managed, their expense ratio, or how much you pay per year to be invested in them, is much lower than with mutual funds. ETFs can be organized in many different ways, by type of company, by size of company, by sector, whatever. There's even PAWZ, or PAWS, which invests in pet care companies. And when it comes to ETFs, your best options are to invest in index ETFs, which track the major indexes. These indexes are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. Most mutual funds never actually outperform these index ETFs. So why would you pay a mutual fund manager to produce worse results than if you just chose an index ETF? So what I'm recommending you invest in is the QQQ, which is the NASDAQ Composite ETF. But please bear in mind, I'm not a financial professional in any way. I'm actually a mechanical engineering major. I just really like this stuff. So make sure you do your own research and look around and see what other options are out there. I would recommend you start by looking at my stock and ETFs video. The link will be in the description below. So the QQQ is invested in the NASDAQ Composite, or the 100 biggest companies in the NASDAQ. Its annual return is around 8 to 8.75% a year, and recently it's even been doing much better than that. And that may seem like a small amount, but over time that produces excellent results in the market. For instance, if we're age 25 and we want to retire at 65, you can see how this works. So let's say we currently have no savings whatsoever, but we're going to commit $4,000 each year to invest in our index ETF. As I said, we have 40 years to grow our money, and we're going to type in the QQQ's annual return of 8.62%. Plugging that in, you can see that we'll have over $1 million saved to retire off of, which is excellent. So start as soon as you finish college and get that first job. Your future self will definitely thank you. Also, quick side note, when you are interviewing for positions or when you're just starting a job, make sure you know what retirement benefits your company offers. You want to see what their 401k match policy is. Often employers will match up to a certain amount of contributions, such as 2%, 3%. For instance, my job at the Naval Research Lab this summer will match up to 3%, and then half of what I do up to 2% more. So if I contribute 5%, I basically get an extra 4% automatically. In short, always contribute as much as your employer will match. It's basically free money. All right, now that we've talked about what actually to invest in, let's take a quick breather before we start the next section. Please feel free to leave a like on this video and leave a comment if you have any questions whatsoever on what I just covered. I'll be happy to answer them. Now let's get back to it. So in this section, I'm going to be talking about the actual steps that you need to do to invest your money. So what I'm going to recommend you do is invest in an IRA or individual retirement account. You could also do a regular brokerage account, but I'm talking about retirement planning here, and this way you get more tax advantages. So there are two main types of IRAs, traditional and Roth IRA. With traditional, you can contribute before paying taxes on income, but on the flip side, when you withdraw funds, you'll have to pay taxes then. With a Roth IRA, it's the opposite. You contribute taxed money, but come retirement time, you won't have to pay any taxes whatsoever. What I recommend you do is open a Roth IRA right now, because chances are your income tax bracket right now is lower than it's ever going to be. And even more importantly, any investments and profits on those investments will not be taxed whatsoever with a Roth IRA. So this way your money can compound with less interference. And there are two important things that you need to know about IRAs. If you withdraw before age 59.5, you will incur a penalty. So really treat this as long-term savings that you'll never touch until retirement, and have a separate emergency account if you need it. And number two, you can only contribute up to $6,000 as long as you've made that annually. And this is why the sooner you start, the more money overall you can invest in your IRAs. So now let's talk about how to actually open a Roth IRA. So at some places you'll need a minimum amount of money to be eligible, but right here is a bunch of highly rated places where you can open one right now for free. I also have a link to my blog post which explains all of this in depth in the description below. So once you have a Roth IRA set up, you can invest in many different things: stocks, bonds, real estate, CDs, whatever you wish. So really a Roth IRA is just a container that holds all your money, and then you have to direct where you invest all that cash. Your choices for how to invest your cash is really determined by how risky you're willing to be. But as I said in the first part of this video, your best low maintenance option is to invest in the QQQ or another ETF, which will grow steadily over time. You may think this is too risky, but as I'll explain in the last part of this video, with proper risk management such as stop losses and also just knowing the overall trend of the market, this is relatively safe and you'll be able to get out before a huge crash like in 2008. So now let me show you, if you're actually going to buy an ETF like the QQQ or individual stocks, how you're going to go about it. So here's how you do it. You're going to have to navigate to the brokerage side of your Roth IRA institution, and you're going to have to make a market order. The process should look something like this screenshot from my Vanguard Roth IRA. You're going to have to make a transaction type, which will be a buy. The system will be the ticker symbol for the stock or ETF, and the number of shares will be how much money you are invested in the stock divided by the current value of the equity. And finally, the order type will be a market order, and then you would just press continue or something similar through your system. With any market order you make, you want to make sure you set up a stop loss to make sure that you're stopped out if the value of the stock drops too much. This is what's going to prevent you from losing most of your capital in a huge stock market crash. And actually, this will allow you to determine exactly how much value you're willing to lose even before you buy the equity. This stop loss is your safety net, and this is what's going to keep you being sustainable in the market over the course of your life until retirement. So this is how you actually set a stop loss order. You're going to navigate to the same place you did for the market order, but this time we're going to change a couple things. Your transaction type will be a sell instead of a buy, and your symbol will be the same one you just bought. Then the order type for this time will be a stop, and then you will enter a value at which you want to be stopped out of your shares. So bear in mind, this should be a little bit higher than what you actually want to sell at, because there could be stop slippage because your order has to go in and then find an accompanying buyer. So it could be that the stock value drops below your stop, and then you find a buyer to sell your shares to. You should set this stop loss order at a set percentage behind the price you bought the stock at. For index ETFs, I like 5 or 6%, and this allows the growth to happen while also getting stopped out of major pullbacks. The beauty of this is that you can set the maximum you're willing to lose on the trade even before you buy the shares. And this is just another way of dealing with risk and being sustainable. At some institutions, they allow you to set an automatic trailing stop loss of a set percentage amount. I personally have to manually move up my stop as the NASDAQ QQQ keeps gaining value. So that is how you actually go about investing with your Roth IRA. The final part of this video is going to be similarly dealing with risk management, but at this time, it's knowing how to know what the overall trend of the market is so that you're aware of any potential weakness like in 2008. The easiest and best way to do this is to go to wishingwealthblog.com, and this is the website of my professor at UMD, Dr. Eric Wish. Dr. Wish uses technical analysis and analyzes 6 different factors to determine the overall status of the market. And this status is reflected in his GMI, or General Market Index. When this GMI is below 3 out of 6 for 2 straight days, the overall signal becomes red. And likewise, when it's more than 3 out of 6 for 2 straight days, it turns green. When it's red, you should probably consider selling your shares, and when it's green, it's okay to be invested. Here's a chart showing the GMI versus the QQQ, and you can see that during the crash of 2008 and at other major declines, the GMI would have given you future warning of the market weakness. This is a proven method of market analysis, and this coupled with your stop losses will give you an excellent risk management system which will allow you to preserve your capital and grow your wealth for the long term. I would recommend, if you are still curious, to check out the rest of Dr. Wish's site. He analyzes different stocks and ETFs, and there's a whole lot that you can learn from his website. Anyway, that's pretty much all you need to know to start investing in the stock market. Just for a quick summary, we first talked about what the overall stock market is and what you should invest in, and then I went and talked about Roth IRAs and how to actually buy stocks and ETFs. The most important thing there is to do your research and pick an ETF that's right for you. I recommend the QQQ, and importantly, you need to set a stop loss with every market order. This is part of your overall risk management, and the last part is to know what the overall trend of the market is. And as I said, with a simple Google search, you can determine what that overall trend is using Dr. Wish's GMI Indicator. So that's really it for the video, guys. Thanks so much for watching. I tried to make this as comprehensive as I could, but if I missed anything, or if I was unclear or missed something, please leave your question in the comment section below and I'll be happy to get to it. Also, make sure to leave a like and subscribe if you enjoyed. I would really appreciate it, and I'll be posting 3 to 5 videos a week about financial literacy and investing. So if you don't want to miss those, hit that button. Anyway, guys, thanks so much for watching one more time, and see you guys in future videos.